A historic collapse is coming. I'm your host, Steve Van Metre, and thanks for joining me today. And legendary investor Jeremy Grantham is warning investors that a super bubble is about to pop. Let's head over to Bloomberg, where we picked today's story up. But Jeremy Grantham warns super bubble in stocks has yet to burst. GMO's co-founder says overvalued equities, bonds, and housing will collide with high rates and inflation to cause more pain. The co-founder of Boston asset manager GMO, known for calling market bubbles, said in a note on Wednesday that the surge in U.S. equities from mid-June to mid-August fits the pattern of a classic bear market rally, common after initial sharp decline and before the economy truly begins to deteriorate. Grantham, now 83 years old, sees more trouble ahead because of a dangerous mix of overvalued stocks, bonds, and housing, combined with a commodity shock and hawkish from the Federal Reserve. And this is exactly what we've been talking about on the show, that high inflation, high commodity prices, they're fine when people have the income to afford them. But when they don't, it leads to a recession almost every time. And what we're seeing in the equity market is the early stage of the bear market, where we have that initial move down followed by a rally, as Jeremy points out. Let's continue on. Grantham predicted around the start of the year that the benchmark stock would plunge almost 50% in a historic collapse. To put that in perspective, you're talking about a revisit of the March 2020 lows. That's how far he thinks it can go down, and that's a long way still from here. The S&P 500 at one point in June dropped almost 25% from its January peak before roaring back in the following 2 months. Yet U.S. equities are tumbling again, falling on Wednesday for the fourth straight session, with prominent strategists like Morgan Stanley's Mike Wilson among those who are cautioning investors that the market hasn't hit bottom, as we covered in yesterday's show. You have a typical bear market rally the other day, and people were saying, oh, it's a new bull market. But that's nonsense, according to Grantham, and that's just exactly what happens. And the question you should be asking is why, when you see these moves down, are people buying? Well, there's a simple answer to that, is because if you look at how far the typical bear market is, well, let's take a look at this. The average bear market is 35% down. Now, how far did the NASDAQ go down? Well, it went down 35%. So what do people think? Oh, this is it. This is the bottom. It's over. I'm going to buy. They come piling back into stocks, and only to find out that the economic data is actually deteriorating from there, and the economy rolls over and heads lower, and then all those buyers eventually turn back into sellers. To Grantham, the collapse of a super bubble comes in several stages. First, there's a setback like the one in the first half of the year, then a slight rally follows. Finally, fundamentals break down and the market reaches its low point. Grantham became famous spotting and profiting from bubbles in Japan in the late 1980s, tech stocks at the turn of the century, and U.S. housing before the 2008 financial crisis. Some of his other bearish predictions over the years have been wrong, or at least too early, and that's not pretty normal for people who spot bubbles. But this one is pretty obvious, because what did you have? You had this massive amount of fiscal stimulus, and it just came flooding into the economy on top of a massive amount of monetary stimulus. And really, if you think about it, the U.S. actually saved the world from what could have been a COVID depression by causing this massive amount of demand, and it just sucked all of this inventory off shelves and out of wholesalers, warehouses, and just evaporated it. And so what happened? All of a sudden, retailers, wholesalers got on the phone and they started calling. We need inventory. We need more of it, and we need it now because there's a line at the door. All these checks are coming in and people want to spend them. And all of a sudden, even through COVID, the lights started coming back on in factories. Demand for workers was there. And all of a sudden you get this big bubble forming, because what happens next? The government ends all stimulus. The Fed pulls away the monetary stimulus. Now all of a sudden you have this little vapor of a bubble that's about to pop in a big way. And this time around, he pointed to the near-term problems such as the impact of Russia's invasion and Ukraine on Europe, which is grappling with food and energy crises, along with fiscal tightening and China's persistent COVID issues. While rising inflation drove declines in the first half of the year, falling corporate profit margins that we talked about in yesterday's show will cause the next round of losses, he said. And here you can see that corporate profits after tax in blue against the Wilshire 5000, the total U.S. stock market in red, both on a year-over-year rate of change. And you can see that profits and stock market go together. In this case, the stock market has been leading profits. Of course, we have this data quarterly, but what it suggests is that likely, as Jeremy's saying, is profits are going to head lower, taking stocks down even further. And my bet is that we're going to have a fairly tough time of it economically and financially before this is washed through the system. What I don't know is, does that get out of the hand like it did in the 30s? As pretty well contained it was in 2000, or is it somewhere in the middle? Of course, the question is when this bubble pops, there's something that shouldn't pop with it, and that's your portfolio. I'll put a link up here to portfolio show and in the description below, because the question we should ask now is, are we on the edge of that bubble bursting? Well, not quite yet. Let's take a look at the manufacturing data as the growth holds steady and U.S. inflation pressures are easing as the ISM gauge of factory activity remains unchanged at its 2-year low, but prices paid are declining now for the 5th straight month, saying that inflation is coming down. The ISM's gauge of factory activity held at 52.8, matching the lowest level since June of 2020, according to data on Thursday. Readings above 50 indicate an expansion in the latest figure compared with a median projection of 51.9 in a Bloomberg survey of economists. And what this means is we talk about that pendulum effect, and the economy is just kind of hanging out here. It's just swinging at its kind of apex. It's about to come the other direction. That's what we're seeing in the factory data here right now. Sentiment remained optimistic regarding demand, with 5 positive growth comments for every cautious comment. Panelists continue to express unease about a softening economy. Of course, what is the driver for that? Most likely, the stock market rebounded during the same time that these surveys came out. So keep in mind, there's a big correlation there. A weaker global economy and recession concerns have led to a pullback in prices for oil, metal, and other commodities. As a result, the ISM's measure of prices paid for materials used in production fell 7.5 points to the lowest level since June 2020. The gauge plunged 18.5 points in the prior month. Now, while we don't have the ISM data in the Fed database, we do have the Philadelphia Fed, their prices paid, and we have them shown in blue. And against the consumer price index, and a lot of people believe that consumer prices are just going to stay high. The rate of growth in them is not going to slow down. But history says when you see the blue line go down, that shortly thereafter, the red line, CPI, is going to go down with it. You can see over and over, and I didn't highlight all the instances, but you can see when the blue heads down, the red falls. And this is telling us, of course, what is likely to come is, of course, the CPI starting to roll over and head lower, and then through the end of the year, decelerate even faster. But what's really the story here behind this move lower in prices paid? Well, as you probably guessed, it's crude oil prices. You've got it. So if we take that prices paid data and now overlay West Texas Intermediate crude in red on a year-over-year rate of change, and what do you see? Crude prices lead, of course, prices paid at the factory going to the downside. It makes perfect sense because crude oil is such a big input in not only gasoline, but in the production of products at factories and the transportation of those goods to the warehouses and the consumer. So it all fits the broad narrative. As oil prices on a year-over-year rate of change or overall come down, well, that means inflation is soon to follow, and that will help burst the bubble. The ISM's employment gauge meantime rose to a 5-month high of 54.2, suggesting more manufacturers were adding to payrolls, but well, what a disappointment that would be. Before we get to the payroll data from today, let's head over to our chief strategist, Jeff Snyder, who talks about unemployment claims. And we talked about that in the show yesterday as they went down a little bit. But he says, in that sense, tomorrow's massive payroll report might be less irrelevant than usual should it be likewise produce a change in the household survey. Don't worry, Jeff, we'll cover this. If the household survey continues its sideways to lower progression, that would suggest merely a pause in the upward move for claims. Continued claims are even more lagging, yet they might become significant for the sort of general, quote, hiring freeze whispered all over the economy by corporate anecdotes. Those who have been laid off yet can't find another job because companies aren't hiring and will be forced to continue on unemployment insurance. Now, if you want to know more about what Jeff Snyder thinks, you can get him delivered into your email box just like I do. I'll put a link in the description below for Markets Insider Pro. We're getting back on track with getting that paid. But in the meantime, so get it while it's free, is let's take a look at the payroll report to see what happened today, because the numbers, well, they turned out pretty decent. August jobs report show U.S. added 315,000 jobs with this headline from Nick Timmerus of the Wall Street Journal, a pullback from July's revised 526,000 jobs. Employers have averaged 387,000 jobs over the past 3 months, a fairly strong showing and well above the pre-pandemic trend, but a slowdown from last year. In August, job gains were strong in professional and business services, healthcare, and retail. And wage growth eased last month as average hourly earnings rose by 0.3% in August, and they were up, though, 5.2%, unchanged from a year earlier. The labor force participation rate, or the share of adults working or seeking a job, increased to 62.4% in August from 62.1%. Of course, he notes that workers joining the labor force could help sustain job growth in the coming months and also could bring wages down. Now, we talked about the manufacturing sector. Check this out. Only 22,000 jobs out of the total 315 created by the manufacturing sector, indicating there is absolutely a slowdown there. But if Grantham's right and this bubble is popping, well, we're getting really close to seeing it, because what is left for the Fed? We have a 75 basis point likely hike at the end of this month. What do we now have? 2 of the 3 data points they care about. What is it? Job openings went up. What do we see? Non-farm payrolls fairly strong at 315. What's left? Well, we have coming up the CPI report. Well, we should see that should dip a bit, but what will happen is it won't dip enough to take the Fed off the gas. They hike in September and blow things up. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.